This Chapter 4 introduces employee stock option programs, or ESOPs, evaluates the arguments for their use by companies and the criticisms they have generated, reviews their accounting treatment, and concludes with a brief description of how issuers hedge the dilution that can result from these programs. A variety of types of ESOPs exist in different jurisdictions and industries, but most of them center around the principle that employee compensation, particularly for senior staff, should include some exposure to the company's stock to better align the employee's interests with those of the company and its external shareholders. According to this philosophy, an employee who owns call options on company stock is motivated to maximize the profitability of the entire company rather than just that of his own division, an incentive that is likely to increase collegiality and cooperation and discourage selfishness and politics. Under the simplest form of ESOP, the employee receives, at some date specified under the plan, the right to purchase a specified number of common shares on or before a designated date at a fixed price, normally set close to the spot price on the date of the award. The tenor of these options is typically quite long, extending often to 10 years or more. A variation on this is known as a stock purchase plan, which requires the employee to set aside from each paycheck up to some permitted percentage to be held by the company in escrow for a number of years, during which the employee may direct the company at any time to exchange the cash balance in the escrow account for common shares at a fixed price specified under the plan. If the share price declines and the employee is no longer interested in exchanging the cash balance for stock, the employee normally receives his money back plus accrued interest at some predetermined rate. You will readily recognize that under either structure, the employee is long call options while the company is short in equal amount. Complicating the pricing of these options, however, are a number of common features that typically skew the value away from the theoretical price under Black-Scholes, including the following. 1. The underlying shares normally pay dividends, which is inconsistent with the Black-Scholes assumption of a zero dividend and raises the need to resort to numerical pricing methods. 2. The options are closer in style to American than European, again inconsistent with Black-Scholes and again requiring resort to numerical methods. 3. The options often do not vest until specified conditions have occurred, which means the employee cannot exercise them until those conditions have been met. Typical conditions include that the employee must stay with the company for a minimum time period and that the company's results must outperform a specific benchmark. 4. The employee cannot sell or assign the options to a third party, which violates yet another assumption under Black-Scholes. And fifth, exercise of the options increases the company's outstanding shares, which requires an adjustment in the value of the options versus an equivalent option traded over the counter between two parties unrelated to the company. This issue arises also when a convertible bond converts into shares and is discussed in detail in our module on convertible instruments. We address next the most common criticisms of employee option programs. These center around the perverse incentives ESOPs may generate among senior management, particularly in instances where options represent a substantial percentage of total compensation. Like any long-call position, the value of an employee option to its holder increases if the stock price rises, which is of course the whole point of these programs. Long-call positions, however, also gain value if either the dividend payout on the shares is reduced, which increases the forward level of the stock, and by extension the value of the call, or when the stock becomes more volatile. Each of these factors is to some extent within the control of management, subject of course to corporate governance protections and the supervisory role of the board of directors. In this regard, a number of studies have found a statistically meaningful negative relationship between the use of options for employee remuneration and the stock's dividend payout ratio, which, stated more simply, means that the greater the portion of options within the total compensation package, the lower the dividend yield of the stock, all other things being equal. Studies also appear to confirm that the greater the portion of options within the total compensation package, the higher the leverage of the company, again all other things being equal. Evidence, in the eyes of critics, that management seeks to increase the stock's volatility and with it the value of their options, possibly to the detriment of external shareholders. As with any correlation analysis, however, it is not possible to establish with certainty a direct connection between the correlated phenomena, and other factors of a less self-serving nature may explain these observed correlations. An additional criticism of option programs is that the strike of the options is often reset lower after the grant date if the option goes significantly out of the money. Management argues that this is necessary to avoid mass defections of employees to competitors with healthier programs. But skeptics wonder if this does not contradict the very purpose of these programs. Accounting for employee options is addressed next. For several years, IFRS has required employee options to be recorded as expenses in the income statement, despite the fact that the issuer does not, either on the grant date or on the date of exercise, relinquish cash or any other asset, nor suffer any diminution in net worth. In cases in which the options are subject to vesting conditions, the expense is recognized, broadly speaking, as the vesting conditions are met over time. Thus, a grant of 100 options, 1/3 of which vest annually if the employee remains with the company, is expensed in the income statement pro rata over 3 years as employee remuneration. On the balance sheet, retained earnings are diminished by an equal amount, ignoring tax effects which vary by jurisdiction and cannot be described in a general manner here, and an equity account labeled stock options granted or something similar is credited by an equal amount. When the option is exercised, the balance sheet entries require a debit, i.e. an increase, in cash by the amount received from the employee, i.e. the strike price of the option multiplied by the number of shares underlying the option. And the equity account is similarly credited, i.e. increased, by an equal amount. The effect of ESOPs on earnings per share is somewhat more complex. Given the potential dilution these instruments create if and when they are exercised, the diluted EPS measure needs to reflect to some degree this contingent dilution. The rule under IFRS, which largely follows an older rule from US GAAP, known as the treasury stock method, requires 2 steps. 1. The issuer assumes that all vested options that are in the money are immediately exercised, but also that 2. The issuer uses the proceeds it receives from employees exercising these options to repurchase shares in the secondary market at the current spot price. Step 1, therefore, increases outstanding shares, while Step 2 reduces them, but by a lower amount than they increase under Step 1, since the spot price, by hypothesis, is higher than the option's strike. On a net basis, therefore, the denominator of diluted EPS increases. For example, if the company has granted 1 million fully vested options to employees with strike 100, and spot today is 125, the above calculation requires the denominator to be increased by a net amount equal to this quantity here, i.e. by 200,000 shares. You will appreciate that for any given number of fully vested options, Step 1 above always generates the same number, or 1 million in our specific example, while step 2 above generates a number which diminishes the further the spot price increases. Therefore, the effect on diluted EPS worsens the more the stock price appreciates. The upper bound for the amount of dilution reflected in the denominator is the full 1 million. But in practice, some smaller number is more realistic, even in scenarios involving soaring stock prices. We complete this chapter 4 by discussing some of the strategies issuers use to hedge this dilution risk. It may seem odd at first that issuers worry about hedging ESOP dilution at all. After all, the grant and subsequent exercise of employee options is cash flow positive for the issuer, saves the issuer cash payments of salary that would otherwise be necessary if an ESOP did not exist, and cannot hurt the issuer's credit rating nor increase its leverage. To be sure, the dilution of profits among an expanded shareholder base is certainly not optimal. But as we have seen, this problem is a so-called rich man's problem, inasmuch as it arises only when the company is performing well and its stock is rising. And it becomes significant only when the stock price soars and external shareholders are becoming rich. Rightly or wrongly, however, many companies implement a variety of anti-dilutive hedges, which range from the simple purchase of offsetting calls or the forward purchase of common shares, as described in Chapter 2, to more sophisticated strategies involving put-call combinations, total return swaps, and prepaid forwards with a variety of embedded options. The choice of the preferred hedging strategy often reflects legal, regulatory, accounting, or tax considerations far more than the underlying economics or the issuer's view of where its share price is heading over the life of the ESOP. The settlement mode similarly reflects accounting and liquidity considerations to a significant degree. Many of these issues will be discussed in detail in a module entitled Forward Equity Purchase, which centers around the hedging strategy employed by a money center bank to offset the dilution from its ESOP and to preserve its high credit rating. For now, however, we have completed this Chapter 4 on employee stock option programs.